It might seem counterintuitive, but in some situations, using a higher rate home equity line of credit, HELOC, to pay off a lower rate mortgage can be beneficial. Hereinafter we will refer to home equity line of credit as home equity. Here's why. 1. Flexibility and payment control. Home equity generally offer more flexibility than traditional mortgages. With a home equity, borrowers can draw on funds as needed, and in some cases, make interest-only payments for a certain period. This flexibility may allow homeowners to manage their cash flow more effectively, especially if their financial situation is fluctuating. For those seeking short-term financial breathing room, the payment structure of a home equity can be advantageous. 2. Shorter loan term. A home equity is typically structured with a shorter loan term than a mortgage, often 5 to 15 years compared to 15 to 30 years for mortgages. While the interest rate may be higher, the shorter term can lead to significant savings in total interest paid. This is particularly true if you have a substantial amount of equity in your home and can pay off the home equity quickly. If the goal is to eliminate debt as fast as possible, the quicker payoff timeline of a home equity could prove beneficial. 3. Tapping into rising home equity. Real estate values in many areas have steadily increased over time, resulting in rising home equity. By tapping into this equity through a home equity, homeowners may be able to free up funds to pay off other higher interest debt, invest in other opportunities, or make improvements to their property. If home values are rising faster than the home equity rate, this strategy may offer financial leverage despite the higher interest rate. 4. Tax advantages. Interest paid on a home equity can be tax-deductible, provided the loan is used for home improvements. While mortgage interest is also deductible, the flexible nature of home equity allows homeowners to deduct interest while still using the funds for a variety of purposes. This creates potential tax benefits, though these will vary depending on individual circumstances and local regulations. 5. Lower closing costs and fees. The closing costs and fees associated with a home equity are generally lower than those for a mortgage refinance. This means that homeowners could save on upfront expenses. While a home equity may come with a higher interest rate, the overall cost of taking out the loan might still be lower when factoring in the reduced fees. Although using a higher rate home equity to pay off a lower rate mortgage might seem financially imprudent at first glance, it can be a smart move for homeowners seeking flexibility, a shorter loan term, or lower upfront costs. The key is to assess your financial goals and cash flow situation carefully. If you have the discipline to pay off the home equity quickly, or if you can use the equity gain strategically, this approach may provide real benefits in the long run. Here is a numerical example. Let's explore a numerical example to demonstrate how using a higher rate home equity to pay off a lower rate mortgage could make sense. Scenario: mortgage, original loan amount, $200,000 interest rate, 3.5% loan term, 30 years monthly mortgage payment, principal plus interest, $898.09 home equity, loan amount, $150,000. This will be used to pay off the mortgage balance after 10 years of payments. Interest rate, 6% loan term, 10 years, interest only for the first 5 years, then principal plus interest payments, initial payment, interest only, $750 per month. Case 1. Keeping the original mortgage. Let's assume you've been paying the mortgage for 10 years already. After 10 years, your mortgage balance has reduced to around $150,000. Remaining mortgage term, 20 years. Remaining mortgage balance, $150,000. Remaining monthly payment, $898.09. If you continue paying this mortgage, after 20 more years, you will have paid a total payments over remaining 20 years, $898.09 asterisk 240 months equals $215,541.60. Interest paid over 20 years, $65,541.60. Case 2. Replacing the mortgage with a home equity. Now, Let's assume you pay off the remaining $150,000 balance of your mortgage with a home equity at 6%. Step 1. Interest-only period. First 5 years. During the first 5 years of the home equity, you only need to pay the interest. Monthly payment. Interest only. 6% of $150,000 equals $9,000 per year, or $750 per month. Total payments over first 5 years. $750 * 60 months equals $45,000. Step 2. Principal and interest period. Next 5 years. After the first 5 years, you'll pay both principal and interest. The home equity balance is still $150,000, and now, you have 5 years to pay it off fully at 6%. Monthly payment, principal plus interest, using a 5-year amortization at 6%, the new monthly payment is approximately $2,899. Total payments over final 5 years, $2,899 * 60 months equals $173,940. Total payments over the 10-year home equity period. Interest-only period, $45,000 principal plus interest period, $173,940. Total payments for the home equity, $45,000 plus $173,940 equals $218,940. Comparing the two scenarios: mortgage, remaining 20 years, total payments equals $215,541.60. Home equity, 10 years, total payments equals $218,940. At first glance, you're paying slightly more with the home equity, $218,940 versus $215,541.60. However, there are key advantages with the home equity. 1. Faster payoff. The home equity is paid off in 10 years, while the mortgage takes 20 more years. You become debt-free 10 years earlier. 2. Flexibility in payments. Home equity offers lower payments during the first 5 years, with the option to pay just the interest, $750 versus $898.09, which can ease financial strain in the short term. 3. Potential savings over time. If you aggressively pay down the home equity during the interest-only period or refinance again, you could reduce total interest paid. While the home equity has a higher rate, it offers flexibility, a shorter payoff timeline, and lower upfront payments. For those who can manage the cash flow or pay the home equity down faster, it could still be a smart strategy. Thanks for watching. Please subscribe.